Traders and investors are adjusting to that news that Moody's has cut the U.S. credit rating down a notch from a strong AAA rating to a AA1. We have Jared Levy, pro trader, standing by. Jared, the bond market is really moving on concerns about this U.S. credit rating cut.
Yeah, a lot of bit of a downgrade. It's funny. So this week, very light on economic data with a lot of FOMC appearances. So we will hear from a lot of members of the Federal Open Market Committee, which again will help shape some of that interest rate environment, which, like you said, this is a big deal. Moody's was the last holdout for the AAA rating for the U.S. government. Now that that's come down, it's really poor timing because this has been a market I'm following very closely. As you know, we've talked a lot about the fixed income market over the past year here on the show. And, in my mind, rates are the biggest stumbling block for consumers and businesses alike. And, obviously this downgrade, what does it do? It causes rates to spike, right? People sell bonds. And this comes at a time when the world is losing its appetite for American bonds to begin with. Why? Because our debt's out of control. We got a lot of things going on. Again, not to get political, but we've really got to slow things down here and rethink what this trajectory looks like. And to be frank with you, I'm short the dollar. I don't believe the U.S. dollar has a lot of support and strength here. And that's something I'm watching really closely. Just overall, the Dixie index is one thing you can look at to see the dollar move. So I'm watching that. Since earnings season is over, again, we don't have a lot of data left this week to really dive into. But I want to hear what the FOMC members have to say, and I'm continuing to watch technicals here. But I'm concerned about what I'm seeing in this bond market, Angie. The fact that yields are spiking, and remember, that controls your mortgage rates, your credit card rates, your loan rates. All those are going back up. And, the Fed doesn't seem to be in any rush to get those rates down. And remember, they can't control those longer dated options or those longer dated bonds. So that's a problem I have, and where I'm still concerned that we do dip into recession.
Ouch. Thank you, Jared.
Thanks, Angie. I appreciate it.